Well, hey there, everyone. Happy Friday, September 5th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an absolutely gorgeously sunny, not too hot, not too cold, kind of Goldilocks comfortable Redmond, Washington. Hope you guys are all doing well and thriving wherever you're at. We are back in the home office here. Excited to be back in Redmond. Sharing some ideas, sharing some perspectives, some observations, some great content with you. I appreciate all the thoughtful comments and feedback and words of support I've received from all of you coming back from vacation, and excited for many awesome things to come with this show and elsewhere in Market Misbehavior. We're going to do an all mailbag episode here. Our market recap show usually involves a quick market recap, discussion of market conditions at the stock level, and then some highlighting some key charts, taking a question or two, but we receive way more questions than we have time allocated on a normal trading day. So I found a while ago, taking Friday, taking a step back, just kind of answering some of the great questions we received during the week. Great way to wrap up the week and set us up for an awesome weekend. Some of you asked about a weekly recap, something that's a little, appropriate for the end of the week. That is something I provide to my Market Misbehavior premium members. So as a friendly reminder, always happy to have one more premium member. You can learn more information at marketmisbehavior.com/premium. Make sure you use the code YouTube when you check out for 30% off your first 12 months on any plan. We have education in the form of virtual courses, research and analysis in the form of our weekly flight plan and monthly chart review. We actually just put out our September monthly chart review earlier this week with some good long-term charts and focus on seasonality. And also a member community where you can ask questions and be in a supportive group, a small group of like-minded investors. Again, more info at marketmisbehavior.com/premium. But for now, I'd love to answer some of the great questions we've received. We're going to start out first, just talking about market conditions here on Friday. We're recording this before the close on Friday. Nice kind of, rally in the afternoon here. Recording this around 3:20 Eastern time. We're sort of midway through Thursday's candle here. If you look, we had a new all-time high today. We did not quite get to 65.50, but we did have a higher open, but we're trading back below 6,500. So certainly for now, feels like that's reinforcing the importance of that resistance level going into next week. About a week ago, that's where we stalled out last week in August here. First week in September, it appears that we are solidifying 6,500 as a meaningful ceiling that would need to be eclipsed. We'll see what happens going into the close, but if we close back below 6,500, I think that sort of sets that up as a potential resistance level. 6,350, the 50-day moving average, that sort of range is where we're eyeing potential support. Looking at the heat map here, just a couple quick observations. Obviously, Broadcom rallying significantly, making new all-time highs, up almost 10% here in the afternoon after earnings. Oracle also a little weaker, kind of bouncing off after a pullback, but having a decent update as well. But I think the real story in technology are the two big names, Nvidia and Microsoft, breaking below their 50-day moving average through the course of this week. Again, we'll see what happens going into the close. But for now, sort of a point of weakness there. A lot of weakness in the financial sector, a lot of weakness in energy. Elsewhere, some interesting bounces that you can see in a lot of the green boxes elsewhere in the heat map. In terms of individual names, we have Broadcom, at least for now, gapping higher at the open, but it's a little misleading to see the stock up 9.4% here, although that is good, right? And it's up for the day. Note how far we are below today's open, right? So a gap and run pattern is where we gap higher on earnings and then we just run higher as additional buyers come in. That's usually the sign of a healthy bull market phase, that initial gap higher is being bought as investors have a lot of optimism about future growth. This more shows you that at least during the trading day, investors are selling that initial gap higher in Broadcom, and the stock's actually trading lower. So not as encouraging as you might think. If you just look at the surface and say we're up 9%, that's pretty good. Like, you're not wrong. That is good. But note how during the day today, there hasn't been a bunch of new buyers come in. There's a bunch of people kind of cashing out, thrilled to have a big gain in Broadcom and apparently moving those assets elsewhere. Now, they're not moving them into Nvidia or Microsoft because both of those two appear to be finishing the week below the 50-day moving average. Again, we got another 40 minutes left in Friday's session, but for now, it looks like Nvidia may be closing below the 50-day. Microsoft having a kind of an aggressive down day pushing below 500 here. I think the 38.2% retracement levels are kind of the next levels I would be looking at, but both of those names showing some weakness here. And that's concerning, right? Nvidia has been diverging with higher highs on weaker momentum, and now we're starting to see some downside follow through. Healthy reminder though, some stock somewhere is breaking out. That's why I sign off this show every time with, it's always a good time to own good charts. There are areas of the market in sectors like financials, in sectors like industrials, consumer, think about home builders, that are actually very constructive patterns right about now, highlighting Stanley Black & Decker, making a new 3-month high today. If we can close around these levels, that would be a completed rotation. I think a valid breakout above the 200-day moving average. I'd be looking at 85 or 87, 87.50, 88, which is the peaks that we saw in Q1. This is a stock that's been below its 200-day moving average since Q4 of last year, finally breaking back above there. So there are stocks that are emerging as some of those leading growth names are pulling back. I would be focusing personally my attention some of those emerging leaders for sure. All right, that is a brief recap of market conditions here on Friday. Let's get to some of the great questions. As a reminder, these are questions I've pulled from our live stream. So when we broadcast live, I'm pulling any great questions from that experience. But also, if you watch our replay on our YouTube channel, you can always put questions in the form of a comment on our YouTube channel. We read every one of those. I guarantee that I do. I try to reply to every one of them that come in, just to acknowledge that we've gotten it, and hand select some of them for this show. Here's question number 1. Regarding Nvidia, one bullish aspect I see is that the Chaikin money flow is still healthy. Chaikin money flow would be much weaker in a bearish scenario. What do you think? Well, as always, no, not making a recommendation or anything, but here is the chart of Nvidia. And yeah, we're seeing obviously some deterioration in momentum, obviously deterioration in price. We're breaking below moving averages, relative strength, of course, going down. But what you're saying is, what about the volume? Which is what Chaikin money flow does, right? And so we can do a couple things with something like Nvidia, right? We can show the raw volume data. So here I've added the volume as a histogram behind the chart. So in this case, black bars represent up closes. Red bars represent down closes. This is showing you the volume in each of those. So it feels like a lot of negative volume here, right? Because most of the last 2 weeks, they've been down closes, and we've got a little bit of an increase in volume. But what Chaikin money flow and a companion indicator called accumulation distribution, what they're designed to do is, instead of just looking at individual daily volume readings, we're looking at a trend in volume over time. So the Chaikin money flow is actually looking at a 20-day look back period, so about 1 month. And this current value basically means for the last month, where has, every day, if the close is near the highs of the day, then that day's volume is mostly accumulation. If the close is near the lows of the day, that day's volume is more distribution, because we're closing at the lows. And so looking at a month period, you can see generally the volume, but weighted by the strength of the price action. So big moves on heavy volume have a bigger weight than, days where the close is kind of mid-range, where it's not much of a directional move, then the volume is much lower weighted. So what we can see here is basically the Chaikin money flow has been bullish above the zero line almost entirely since the beginning of April, right? Since that April low. There was that period in mid-June where we stalled out, pulled back a bit, and the Chaikin money flow went briefly lower for about a week, but after that went higher. And since the end of June, it has been consistently strong. So I would agree. Even though the price is breaking down, even though the momentum is getting weaker and the relative strength is underwhelming, the Chaikin money flow tells you the volume is still okay. And all that suggests is that you just really haven't had these big puke out down days. And if you think about how does it make sense that the volume, these are big volume days and they're red, which means they were down closes. So why is the Chaikin money flow not going lower? It has to do with the calculation of the indicator, which is a brilliant piece of how Mark Chaikin designed that indicator, right? Look at these 3 days in particular, right? Or any of these, right? This is a down close from this day to this day, right? So that's a down close, which means you go down here, that day's volume is red. And that's why daily volume readings can be a bit misleading. What this red volume basically is implying is that that whole day was a big distribution day because it was a down close on heavier volume. But if you look at the price bar, the close was almost in the middle of the range, right? So even though we closed lower than yesterday's close, really didn't sell off a lot during the trading day, right? We traded around a little bit, but we kind of closed mid-range. So the chicken money flow actually didn't change much at all because it wasn't really distribution according to that methodology. This is, I sort of recognize this as I was learning about some of Mark Chaikin's volume indicators. I realized how much I was making huge assumptions by just looking at daily volume readings. What you're doing is mentally thinking that an entire day's volume is either really bullish or really bearish. And what the Chaikin money flow and other related volume trend indicators do is they have a much better analysis, I would say, a representation of the relationship between price and volume. So I would agree. The Chaikin money flow is actually quite bullish. So that is one piece in the Nvidia mosaic that is still bullish. Is that enough to make me still super excited about Nvidia because everything else I'm looking at is mainly bearish? It is not. So I'm going to have to look at the entire checklist. That's one bullish item among a bunch of bearish ones, but I would agree that is a healthy thing. And I would say, talk about something that would really be the nail in the coffin. You see the Chaikin money flow break below zero. I would be very concerned about downside potential for Nvidia. Next question. Do you see CRDO going up any further, or is the run over? As always, standard disclaimer, this is not a recommendation by any means. I'm just making an observation based on the best practices of technical analysis. Please do your own due diligence, as I always remind you with the disclaimer at the end of the show. But so what do I think about CRDO Technology Group? This is a technology stock. I mean, it's making new all-time highs today, right? So I think, how do we define this chart? So I think of it as a checklist. This set of indicators that I use is kind of my default set of indicators. Let's go from top to bottom. What is the price telling you? Well, we're making higher highs and higher lows. That's bullish. What are the moving averages telling you? Well, the price is above the moving averages. The moving averages are in the proper order, and they're all sloping upwards. That's bullish. The relative strength at the very bottom telling you CRDO is significantly outperforming the S&P, certainly since April. All true. The momentum, so we had a bit of a momentum divergence here in July into early August as the price is making higher highs and weaker momentum. Late August, when we made the most recent new high, lower RSI. But what's happening this week, I think, is pretty important. We're making new highs on stronger momentum. And that's how a bearish divergence can have a positive resolution. The way that things get better and the way that you kind of negate that divergence is you have a breakout on stronger momentum. You have new momentum coming into the name. And I think that's what we've seen with CRDO. So short answer is this is a chart that is going up and to the right. The weekly chart shows you how aggressively this thing has been moving higher. I don't see a lot to be particularly concerned about in terms of the chart. I mean, if there's anything, Chaikin money flow sloping downwards a little bit. I don't know exactly what we've been called. Oh, it's because we closed at the lows of the day yesterday. So we gapped higher and then closed lower, which caused the Chaikin money flow to come off a little bit. And maybe one thing that I'd be keeping an eye on. But other than that, up and to the right? Strong chart, innocent until proven guilty is how I would generally think about that. Sticking with this, it's an all technology thing. Some of the other questions are not technology related. I didn't really think about that as I was putting these together. The technology ETF, the XLK, in the past 3 years between September and October had dropped below the 50-day simple moving average. Do you see anything that would suggest the same in 2025? That's an interesting question. Let's start. And just as a reminder, Stock Charts has a really great, simple but powerful seasonality tool. You switch at the top from sharp chart to seasonality. You can put up the ticker to look at the that particular stock or ETF. If you want to look at the relative performance, just put something like SPY on the right. Now you're looking at the seasonality of that relative ratio. We're just going to look at the the straight data. I'm going to move this back just so we're looking at the last 5 years to start with. You'd actually said the last 3 years. But in any of these timeframes, you can see last 3 to 5 years, September's been pretty rough. And that's true for the S&P 500. That's true for technology. It's true for a lot of things. Right? Stocks have just generally not had a particularly great September. Over the last 5 years, kind of the post-COVID era, technology is down an average of 5.4% in the month of September. It's been only up one of the last 5 years. That's not particularly good. If we go out a little bit further, about 20 years, you can see it's not as negative. It's more of a coin flip, but it still has the worst average returns of any of the 12 months going back for the last 20 years. So September is usually pretty weak for technology, usually pretty weak for stocks as well. Now, you had implied, looking at the last 3 years, you're saying, look, we often pull back to the 50-day or drop below the 50-day simple moving average. So here's September of 2024. We indeed broke below the 50-day and got down to the 200-day moving average, actually, there in September. Here's September of 2023. We broke below the 50-day moving average. Did not get all the way to the 200-day, but certainly got close to it. I'll go back a little bit further, like 3 years and a half. And we can see September. I mean, September of 2022 was, we were already in an established downtrend. So I don't know if that's a great analog, because we were we broke below the 50-day, but we've been going down for, pretty much the entirety of 2022 going into that point. September into October, we're below all the moving averages here. So, yeah, I mean, I think there's a seasonal tendency that's happened. So what does that mean? For me, remember, seasonal tendencies are tendencies. They're not absolutes. There's no guarantee that September of 2025 is going to be weaker than normal. The fact that it often happens around this time just tells me, listen, be ready for some sort of pullback, because that's happened most years in recent history. Do I see anything in the particular chart now that suggests that we may have a similar kind of pattern? Well, that's where there are a number of parts of the technical toolkit that are more leading, right? More anticipating what may come next. And if we just zoom in a little bit here, I mean, I think the biggest challenge I see on the chart of technology is the divergences, the clear divergences that we've seen in July into August and now into September, right? May, June, July, we're seeing higher highs on stronger momentum. That's what a healthy bull market should look like. When we're making new highs, you would expect the stock to become overbought, or the ETF to be overbought, which represents an influx of buying power, optimism pushing prices to new highs. When we start making new highs on weaker momentum, a previous period would be like first quarter of 2024. We're making new highs, but the RSI is not becoming overbought. So that tells you something's different from January to March, where these new highs are marked by weaker momentum. We're seeing that kind of thing here. Now, what happened after is that break of the 50-day is often a really good sign that there's going to be further deterioration. And I think that's where, I guess, to your point, holding the 50-day is pretty important here, because, again, as a short-term gauge of strength, the 50-day moving average is a good, simple kind of litmus test of, are we in a decent uptrend or not? And if we break below the 50, that doesn't mean we necessarily go to zero. It just tells you that whatever uptrend phase was happening before then is probably over. We have a change of character. We'll see what happens. It looks like this week we're sort of testing the 50-day all through the week. I think in the week to come, going into next week, we break below the 50-day. XLK breaks below 255. RSI breaks below 40. That would be a very bearish rotation. If I held XLK directly, which I don't, that's where I'd probably be lightening up in positions myself. So yeah, I'm seeing concerning signs of divergence in August now, which tells me September maybe follows that traditional pattern. Would not be surprised. Next question. Why do you prefer the calculation of RSI, which looks at average up to down days for momentum, over something like stochastics, percent of high-low range? Hey, I love the fact that in your question, you're implying an understanding of the calculation of these indicators. In a quick story, and I've probably shared this many times, but when I was learning technical indicators, I was at Bloomberg, and one of my mentors there basically gave me the homework of every day it was a different indicator, and I had to prove it out in Excel, download the raw price data, and show him the results of my Excel spreadsheet that would match what the Bloomberg system, the Bloomberg platform was showing. And that was the way that I learned the calculations of every indicator that we had on the platforms. I had to basically prove it out in Excel. And I hated him, and I hated that exercise because it was just a bunch of Excel, and I was doing it like in the evening when I didn't want to be at work anymore. But looking back, like I just understand the calculations very deeply because of that exercise. And then for years, I mean, often I would be asked, to come into a situation if someone was looking at RSI and disagreed with our calculation, I would need to prove it out. No, this is why this number makes sense. And I would show them an Excel sheet and say, look, this is the number we're showing. This is where the math is. This is why we're right. Whatever that other platform is, they must be doing it wrong or differently or something, because this is the calculation we're using. And I guess I appreciate it now, 20 odd years later, for forcing me to do that. Having said that, why do I prefer these? Well, so for me, I think the journey of a technical analyst or a technically oriented investor, I found, has 3 phases. You have phase 1, which is like the rookie phase, the beginner phase, where you're just kind of, you usually are using things incorrectly. You've heard about technical analysis, you've read a book or something, and then you start, just using things, but you're probably misusing them. You're not using it well. And you don't have enough experience to understand that you're doing it wrong. So you get crushed in different ways. And those painful early experiences help you move to the second phase, which is trying to put more structure. And what I found is a lot of people in that phase, for me, was going through the CMT process. You all of a sudden look at a bunch of stuff. You create these charts with all these lines because you feel like if I just throw enough data and throw enough lines on this chart, it's going to start making sense. And then you have the analysis paralysis problem, which is you're trying to look at too much. Then you hopefully get to that third phase, that expert phase, where you simplify. You start simplifying and you go back to the basic kind of foundational principles of technical analysis. And I realized for me, there were kind of 3 things I wanted to understand when I was looking at a stock or an ETF. I wanted to understand the trend, I wanted to understand the momentum, and I want to understand the relative performance, right? What is this price doing? What are the momentum, right? How is it getting from point A to point B? And then the relative performance. How does this chart compare to other charts I could be looking at? And then I had a bunch of other tools in the technical toolkit that I could use. If something wasn't clear, if I wanted to dig a little further, then I could look at other timeframes or bring in these other indicators. And, so certain indicators like Bollinger Bands, I think, are fantastic. And if I was a swing trader or an options trader, I'd probably use it a lot more. But in my day-to-day work, I don't look at it very often. However, if it's a stock kind of in a clear trading range, sometimes I'll throw them on there just to kind of put it into context. Think about, all right, well, what are the Bollinger Bands telling me about the range that we're working with, and what kind of would be an extreme move, and how can I kind of play an exit from that consolidation? Right? That's when I would use maybe a secondary indicator that's not a main part. Stochastics for me are just one of those secondary indicators. For me, RSI has ended up being a big part of what I do. Part of that is meeting people like Andy Cardwell before he passed away, Connie Brown, who wrote books about indicators like RSI. And they both were huge fans. And Cardwell in particular, I mean, I sat in presentations where he talked all about RSI. And I realized from his work how much you could get out of just looking at RSI. It wasn't just, is it overbought or oversold? And that's how I kind of used it before kind of hearing some of his presentations. I realized there was a lot more I could understand. And Connie helped me think about the range rules of the RSI and how to change the ranges, how that completely opened up a different way of thinking about multiple timeframes using momentum. So I've spent the most time using it. And for me, having it there is just a great visual representation of the momentum. And a lot of things that, for me, divergences have become a key part of it. So it's not to say that stochastics is not great. And some technical analysts like Katie Stockton use stochastics all the time and serves them well. And that's great. You can't look at everything. So I think you end up finding kind of that default chart that kind of has your main way of understanding something. And then you have these other things which you can draw on when the conditions suggest it. I would say for something like stochastics, that's one of those indicators, and I'll put it up on the chart. I mean, it's similar in terms of the general idea. I mean, it's very similar to something like RSI, and then it's an oscillator and it's measuring price momentum. It's just doing it in a very different way. If I was a swing trader primarily, I would probably lean on stochastics much more, because that's really designed to help you identify, when we've had an upswing, recognizing that that's an extreme and then seeing that breakdown as a rotation back to the lower level and seeing the bounce off of the moving average with an improving stochastics. Like, it's more of a swing trading indicator in my experience. I'm looking more longer term, and so RSI, it's better, I think, for medium term, longer term timeframes. Draw your own conclusions, though, and if you have longer term ways of thinking about stochastics, I'd be interested to see what you do. Next question, and probably the final question now that I look at the time. Dave, when you scan for prices above the exponential moving averages, do you use a specific percentage or greater than the previous day's close, or just each of the above? This actually came from a different video I did on my YouTube channel, talking about the 21-day exponential moving average and just thinking about how that fits into my process. That's the green moving average you see here on the chart of the XLK. For scans, here's what I actually keep it super simple, because for me, you're really just looking for, for me, I actually just scan on where the price is relative to the moving average. I kind of keep it pretty simple, but you can do much more exotic things. For example, this is a scan that I run often called moving averages bullish. And this line right here is kind of the thing. So the 20-day EMA is above the 50-day simple. The 50-day simple is above the 100-day simple. The 100-day is above the 200-day simple. This is what we call the moving averages in the proper order, just making sure that these are an uptrend. And the results of this scan will be stocks kind of in nice, consistent uptrends. I just always want to know those charts and know which stocks and sectors are able to or come up on these results. I think those are good stocks to know. And also the ones in established downtrends, which would be the moving averages bearish scan. You can do simple comparisons with most scanning tools. Just saying the price above the 21-day EMA would be an easy way to do that. You can do percent, right? So you could say, it's above 1.02 times the simple moving average is kind of the way that a lot of platforms have you do it. So the current moving average time, so if I want to make sure it's at least 2% above the 50-day moving average. Stock charts, if you use the stock charts platform, actually has an indicator called distance from SMA. You can see, or dist from EMA is the argument. So if you hit pause, you can use this argument to actually say, this is basically saying distance from the simple moving average, the 50-day daily using closing data is over 20. So that would say stocks that are at least 20% above their 50-day moving average. I don't run scans like that very often, but depending on what you're trying to identify, you certainly could. That's also the way, by the way, you can look for stocks very close to their moving average. Say it's, less than 1% above and more than 1% below, which means it's within a 1% band of a 50-day or 200-day moving average. That's often a way you can scan for stocks looking for particular relationships to their moving averages. All of that's possible. For me, though, I keep scans pretty simple. And for me, I'm generally looking for things that are above there. And I also look for crossovers, which is something you can do on the Stock Charts platform as well. There's an article. If you go to Stock Charts, go to what's called Chart School, which is a free part of their platform. Search for this. It's called Distance from Moving Average. You can find some of the indicators that allow you to measure that, and also some of the scans you can use. They have a bunch of example scans and others that look for those. And if you're using other platforms, I would ask those platforms for resources on how you can structure and scan for some of those things. All of those things are possible. Do I use many of those in my own day-to-day work? I don't. But again, scans are about you scanning for things that are going to help you answer the questions you're asking. And if you're asking different questions than I am, make sure you leverage those platforms to help you get to the right charts to review. That'll do it for today. Thanks so much on my first week back here, engaging, watching the content, sharing some questions, sharing some feedback. Great to be back with you. I'll look forward to next week. I am traveling next week. I'm going to a conference called FinCon, which is a conference for financial bloggers and YouTubers and podcasters. It's a great community, just kind of helping me think about how I'm getting my content out to you and how to do that a little bit better. So hopefully I'll come back with some good ideas about how I can better produce and distribute some of this great content. But for now, I'll say thank you so much for watching. Have a wonderful weekend. And remember, it's always a good time to own good charts. Take care, folks.